Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 14th, 2022, S&P 500, currently sitting at 3601. I'm David Zarling. I'm here with Ian Squirrelskin, Coin Purse, McMillan. Lots to cover. We've gone a lot of places, but arguably nowhere. 2 Fridays ago, we closed at 35.85. Last Friday, we closed at 36.39. And currently, we sit at 3,600.
Right in between.
It's like the market just went nowhere, correct?
It did. Yeah, I mean, if you tune in on your Fridays or check your account at the end of the week, been pretty uneventful. But obviously this week, quite a bit of, there was a lot of action yesterday. We'll say that.
Well, yeah, we had the gap down.
Big gap down.
The noise event of the day was the CPI print.
Mm-hmm.
And price. We don't really care about that. In fact, I don't even know what they were expecting for that. But what we care about is the price reaction.
Mm-hmm.
Price gap's down 2%, and by the end of the day yesterday, it's up 2, maybe even more. And I believe it was like a 5%, 5% turnaround day. And depending on where we close, what's interesting is the last 2 weeks of information on using something like the S&P 500. We're going to have a range from the last 2 weeks that's about 8%.
Wow, really?
Yes. So the high from the week before with the low this week is just greater than 8%. So while we
have overall from last week's close, we're down about 60 basis points.
Yeah, about you could say between
maybe a percent,
almost a percent, like 0.9.
Yeah.
And it's last week we had what was called an inverted hammer from a technical standpoint, which just means that you have an opening price moves higher the entire week until the end of the week. It reverses back lower, closes green for the week, but leaves a whole bunch of data above it, known as a wick and an inverted hammer. And it can be a reversal, potential reversal, meaning like the downtrend could reverse at this point, because that's what we've been in. But you need follow through to confirm that. And I would argue it's not even really an argument. We haven't had that this week.
No. And there was even talk of, I saw this thrown out twice, but people attempting to use yesterday's price action as a bread thrust.
It's rough.
Yeah.
It was an 80% update, but that's only one day.
Well, it's an 80% update, but when you look at new highs minus new lows had its worst day, and it was a great intraday rally. It fixed nothing. And to your point, yet again, zero follow through.
Yeah, it's the same team we've been watching for 10 months now. Technically 18 months when we look back, or more when we look back underneath the surface.
Team that gets the ball into opponent territory and either there's an interception, misses the field goal, turnover on downs, you name it. Just can't get it going.
And in the past few weeks, we've talked about a 200-week moving average. We still have several major indexes, most major indexes below that. S&P holding on above that currently. 200-week moving average is at 3,599. Currently sitting at just above that on the S&P 500, but we've talked before that Qs is below it, small caps are below it, and various other instruments, with the exception of something like energy, which is not. And energy is showing that relative strength continually. And that's
Energy,
information.
yeah. New relative highs for the sector as a whole this week. I think MLPs as a sub-industry got there last week. But that continues to be the story, maybe one of the only bullish stories as far as stocks go for 2022.
Oh, for sure. And, when we look at historic market performance and the mechanics of accumulation and distribution, or mechanics of a bull market and mechanics of a bear market, we've talked in the past about stages of a market, and in stage 6, which is the final stage, you see stocks down, bonds down, commodities down, or all 3 major asset classes down. And really the one that tends to indicate whether we're going to see a stage 1, a return to accumulation, is really credit, is the bond market.
Well, nothing's changed there.
Yeah,
stocks might have had some back and forth this week, but bonds continue to not have a lot of back and forth. That is...
Yeah, and right. So
great.
Stocks had that nice one-day move this week and bonds didn't flinch. Bonds being treasuries.
This will be the 8th straight, and 11 out of the last 12 red weekly candle for long-term treasuries.
Yeah. I mean, that's pretty serious.
That's one positive week, and it was up maybe 0.5% that week. So one green week in the last 3 months.
Yeah. Well, and what if I told you, technicians are able to, we have basically degrees in studying supply and demand. And if I told you that consolidation that took place in long-term treasuries from June through, let's call it mid-August, that particular consolidation actually has us targeting $85 on TLT. So an $85 level on TLT would be equivalent to a rate level on near 5.6.
She is so that's the December 08 blow off highs when everyone rushed to treasuries, and then you had your real sell off right the beginning of 09 when they didn't want to own anything,
right?
And then everything. I guess treasuries didn't really bottom until June. Stocks obviously bottomed in March. And then the lows from late 2013, early 2014. So a big behavioral level. So you're saying measured move says we still have another 15% or so maybe to go.
Yeah.
In treasuries.
And that's more conservative than, I think it was like 4 or 5 weeks ago, we talked about the 6.4 level as far as rates go on a 30-year as an overshoot equivalent to the undershoot that took place during the COVID crash, where everything was getting sold and bonds got sold, that would be a reversion past the mean, would be something above 6 on the 30-year treasury.
And how about, speaking of targets, so we talked about a lot earlier this year about that 3 and I'm speaking on 30-year yields, treasury yields, that 3.4. We had a big rally into there, sold off, got back through there late August. The next target would be 3, we'll call it 4%, which was the highs from November 2013.
Mm-hmm.
So we got there this week. And first first visit, maybe only visit, hasn't stopped. We haven't got much resistance here. We're now above that level. And now we're back to where we haven't seen 4% since 2011.
Right.
Quick. But
And
yeah, I mean, we stay above these June 2014 highs.
And so the data continues to confirm that we're in a stage 6 market contraction, meaning 3 major asset classes down, bonds, commodities, and stocks. Stage 1, you typically see bonds return to favor first. Now, we need to see that. We haven't seen that. Like, it's just really simple. You need to see bonds stop going down, which we haven't seen yet.
Way to say it. That's the easiest way to say it, Dave.
And from time to time, actually always we have great conversations with our clients, but from time to time in those great conversations, the question of like, hey, like I hear rates are up. How can we take advantage of this? Part of it is, though, recognizing that even though we're close to 4% on something like a 20 plus year treasury, you have to wait for that instrument to stop going down, because you could buy it and it falls another 4%. Now you've evaporated the yield the coupon that you purchased. Now on the shorter end, right, there's plenty of opportunity in something like T-bills to generate, 1.8 to 2.5% yield, which we've been doing for our clients. That's great. But these other longer duration vehicles, whether it's treasuries, liquid corporates, last week I think we talked about junk bonds, Ian, those still have to stabilize, and they haven't. So we can't really take advantage of them until those stabilize.
Junk bonds never confirmed any type of failed breakdown back above their June lows. High yield spreads
right,
continue to move higher.
Yeah, and that's a sign that we've talked about in the past of tightening liquidity. Markets are built on liquidity, meaning like you have to have them. It's the oxygen for the system. And it's interesting that the last 2 weeks of market information, that range of 8%, it really brought in buyers and it brought in sellers. And if there's not liquidity in the system, it's going to find it. And that's what the market does, is find liquidity. And the way it did that is with that 8% range over the past 2 weeks, is bringing, because that's all market is matchmaking, right? Finding buyers and sellers to match. And sometimes it has to have these outsized ranges in order to make that happen. And that's what we had this past week. And as far as bonds are concerned, we haven't found enough buyers to support any type of basing or stabilization. And so bonds remain hands off. And it's one of the worst periods ever for bonds. The 60-40 portfolio, 60% stocks, 40% bonds, is now in a correction greater than 30% that exceeds anything we've seen in the past 100 years. And that data is from Bespoke and Bank of America. That typical portfolio makeup, 60% stocks, 40% bonds. We haven't seen something like this in 100 years, but that's what markets do, right? Markets are fat tails. I think, you mentioned how often an extreme event happens. For example, Thursday, as far as price action goes in the market, we don't see that very much. Same thing with the 60-40 portfolio. We're seeing a 100-year event. That's what markets are. They're ongoing extreme events, and that's why you have to manage risk. You don't just own bonds for the sake of owning bonds because the industry or the textbook or even the Series 65 test, which pushes or tells advisors they should, in a conservative environment, have their clients invested in treasuries. Even a licensing test can't capture what happens in markets. Only price charts can do that.
Regulators.
Hey, we love regulators.
I've had enough of regulators this week.
No, we love regulators because we need to know the rules.
Yeah.
And the licensing tests are great because you do want to have like an understanding, like the Series 65 test is a very comprehensive test. It does a great job. It's a depth of knowledge. And my point is not really to slam on the test. It's just to acknowledge the textbooks and even a licensing test point towards bonds as being less risky, carrying less risk. And that's not what we've seen.
No.
These are just facts. And the
Facts
only
of life.
the facts of
Trend
life
is down, and there's been, I would say, less choppiness out of bonds. Have been, compared to stocks, have
Straight.
seen a lot less
straight line.
a lot less attempts to carve out a bottom. We've seen demand come in pretty strong. I mean, we had the June, July, August rally, and even days like yesterday, where there are hints of demand. They don't last very long, but in the fixed income space, it has, yes, to use your terminology, it has been straight down.
Well, and for comparison's sake, so let's just use something like the S&P 500 compared to its June low. As we sit today in this moment, it's about 0.9% below its June low. When we look at 30-year treasuries, we're about 9.5% below the June low. So bonds have been that much more weak than stocks. And here we are in the midst of a 20+% correction for equities, and retirees who were fed the 60-40 model are paying the price for, let's call it recency bias, the past 40 years of information, which has only seen bond prices, rise and yields fall, and a non-correlated asset class to equities. Well, what if now we're in a new era, which we've talked about? I mean, I believe we talked about this a year ago, a new era where stocks and bonds are more correlated and the risk parity trade is over. Risk parity meaning if stocks go down, bonds cushion that type of price action. We're not seeing that. And so we are looking for clues from the bond market, and they're not providing them yet.
Any other markets? I would say another market that fell apart surprisingly quickly. Yet again, maybe not so surprising. It is precious metals, but yeah, gold and silver.
Yeah, that's a good point.
I think silver's back to, gave up a 20% rally.
Yeah,
over the last week and a half.
I think that's a great observation, because gold overall, and I know you're talking silver, but we can talk precious metals complex. Gold futures had reclaimed an important level above 1,700, and that's failed again. And related to that, you're saying the miners of those elements also suffering.
Yeah, and silver.
Yeah.
Man, it's just
commodities remain in a downtrend.
All fell apart. I mean, take Newmont, for example. I mean, the biggest of probably most well-known, I guess you could throw Barrick in there. But, rallies 10%, right back to where it continues to build what now looks like a, bearish consolidation in a downtrend.
Mm-hmm. So no relief for commodities. When we look across the board there,
oil straight back to $85 after it had, this could be a retest, but again, an asset that had a failed breakdown, showed strength. Absolutely. I mean, still holding 85, but no follow through off of yesterday's candle either.
Right. And this goes back to the underlying ratio, right? Because all of these things are priced in
dollars.
And the dollar strength has not abated. We continue to see it move higher against a rising 200-day, rising 50-day, rising 20-day moving average. It is one of the stronger uptrends, which is also another thing they don't teach you in the textbooks, is that it's possible for there to be dollar strength and bond weakness. Many economic textbooks would tell you that bonds and the dollar tend to rise together. We're not seeing that. And that has an impact on commodity pricing.
It does.
And meanwhile, currencies across the planet, though, are having different results.
Because of their domestic currencies moving
Lower. Yeah. I mean,
I think you see that. Right? Brazil, pretty big ag country, continues to hold up well. Latin America in general.
Well, and what information is it providing us when the Bank of Japan says they're going to directly intervene in their currency, in the yen? And from that point forward, we continue to see the yen depreciate against the dollar almost 3%.
True.
So I'm not here to say that central banks don't manipulate currencies. The U.S. does it too. Like, I'm not in here for the moral argument about who manipulates their currencies and who don't. They all do. But this was a direct statement saying they're directly intervening in their currency. Some of these other central banks are doing this on the periphery. They're saying we're directly going into the market, and they can't control it. And so you have all these other currencies across the planet that continue to weaken against the dollar, with the dollar being the cleanest shirt in the closet. Meanwhile, go ahead.
Oh, no, you go ahead.
I was just going to see, meanwhile, we've got bonds falling off. And that's not just U.S. The Treasury thing, the Treasury sell-off is not just U.S. The biggest story probably is probably the gilts, the British, British bonds that are selling off hard, and the Bank of England jumping in and trying to provide some liquidity to the pension funds over there. But we're seeing bonds across the planet get sold, and that's not new.
They are.
So
they are.
What were you gonna?
I was just gonna say, Ibovespa.
Oh yeah, the Brazilian.
It's up 12% this year.
Mm-hmm.
Priced in, obviously, Brazilian reals, but I just think it's a great example of dollar strength has been, depending on what currency you're investing in and what stock market, but holding in there pretty well as far as an index goes.
Well, and as far as international stocks go, when we look internationally, again, another thing that modern portfolio theory tells you is that you should be owning international stocks no matter what. And I don't know how many times we have to hop on here and say that's garbage. That's a garbage theory, because we have the data to show us when international stocks are not in favor, and all we continue to see on a relative basis is international stocks underperform. And there'll be a time again where it makes sense to own international stocks, but it's not right now.
Sometimes I wonder.
Sometimes
I wonder.
No, for sure.
Speaking of foreign, China.
Yeah.
Zero. I mean, I still think China closed red yesterday, right?
It did.
Looking at the typical large U.S. Chinese ETFs.
Yeah, no, for sure.
No demand there. Very hard for me to believe that if investors are not willing to buy U.S. Treasuries, I don't think that they're going to come running for the hot software, small cap software names anymore. Or maybe they will, but they're like you said, they're going to come for bonds. They're going to buy bonds first.
No, I think your point is extremely valid. Like, why, if we can't buy bonds, why would we buy the high growth, zero cash generating software stock?
Yeah.
No, that's fair. That's 100% fair.
And you've got a lot of these other value areas like banks. I mean, banks look good on a relative basis.
No, and that's an important development. I think that's worth you talking
Right, because there's
about.
a lot of this, oh, well, aren't banks supposed to do great in a raising rate environment? Well, yeah, I mean, unless the entire market's going down, but I do think that banks will, when this does turn around.
Well, no, let's talk about that a little bit because I like the thought process on this because you're saying, okay, we have a weak market across the board, but there's some relative winners, and I should say weak market across the board with the exception probably of energy and some financials and banks like that. But
Yeah,
you're
and
saying
some biotech has been
right, but you're saying if we ever establish a bottom, there's some strength out here worth noting. Is that a fair?
I would say there is, and it continues to be value-ish.
Yeah.
I guess maybe not biotech. I don't know what bucket we'll throw that into. But yeah, banks, energy. I mean, when you look at the breadth data, new relative highs, and you go through the charts like a day like yesterday, where there actually were, now there were still a ton of names making new lows because of how big the gap down was. But when you look at new highs, it is definitely littered with banks, regional banks, not your big ones, but definitely regional banks.
Well, and how much irony is there in that from the sense of, what should we say, anything in the last 12 to 18 months? Remember when it was, banks are done, fiat currency is done. And so, and here we are in an environment with strong dollar, strong banks. It has to really irk everybody that thought that those systems were going to die. And maybe they will. Maybe they will eventually. I have no idea.
Crypto's
but the narrative
60% off its highs.
Right.
70%.
And I'm sorry, you said
very ironic.
You said Bitcoin?
Yeah.
Yeah, let's talk about that. I mean, one of the interesting things, and we can get into volatility in the VIX here shortly, is how calm the range on something like Bitcoin has been for a while now, against a very important level. We could call it anywhere from 18,300 to 20,500 for this instrument. For crypto,
yes,
it's a narrow range. It's a calm range, and so it's going to be interesting to see how this plays out. And again, we go into another weekend where it's going to be interesting to see because from compression comes expansion. And it's safe to say that we've been seeing crypto assets, specifically Bitcoin and Ethereum, which are the largest parts of that market, compressing. And so directionally, I can't sit here and I have a thought on where it might go, but directionally where that expands to will be important information. If that rips higher, that's probably happening in a risk-on environment, and we're seeing stocks move higher and bonds stabilizing. That breaks lower. I think that's information too, below 18.3.
Yeah, if you were to get Bitcoin above 22,000, certainly above 25, I think that gets put in the broken rate of trend bucket. Now you're going to have a 200-day moving average up there to contend with.
Right.
Because the downtrend here, the long-term trend here is still definitely down. But, I mean, we continue to sit below the December 2017 highs, which I don't ever think we technically got to 20,000 back then. It was like slightly below, like 19,700 or something.
No, this is good. You're saying the December 2017
struggle there.
Highs in Bitcoin. So that high around 19,370 on a weekly. Yeah, we're right there.
Or even on an intraday, I mean, that's where we get. And then of course you've got dueling tails, right? And Bears had their chance yesterday, right? We like to poke at the Bulls every time they get a chance. They don't do anything with it. Not like the Bears did much yesterday either. They had a chance, especially on this asset. You could have gotten new year-to-date closing lows on Bitcoin yesterday. We were there. We got new year-to-date intraday lows.
Well, it's another group that's below its 200-week moving average. And like you look at Ethereum and it's right at its 200-week moving average. Bitcoin is below it. And I apologize that we're focusing on those two the most, but they're two of the biggest. And so it's worth paying attention to them. And so they are in a very interesting territory, below 18,300. I think it's super hands off. That's not a recommendation or some type of investment advice, but for Bitcoin below 18,300 doesn't make any sense. And we continue to see many stock indexes below their 200-week moving averages.
Yeah.
With the exception of S&P right there, right now. And we'll see if that holds. That's really going to be the telltale sign. We go into another weekend where the tail risk or the risk of a big event happening over the weekend that takes stocks significantly lower is elevated, because we never really cleared anything out this week. Had a chance yesterday, failed again today. Now, I guess we'll see where we close in 2 hours. But for right now, bonds remain guilty, stocks remain guilty, commodities remain guilty, crypto remains guilty.
When you said right here, right now, I thought I was listening to a Ford commercial. Do you remember those?
Right.
I think that was Ford. Wasn't it Ford?
Well, I thought isn't that you're talking about the song Right Here, Right Now? That one?
Yeah, that was like it's someone had that as like a commercial jingle. Right here, right now.
It could be. I mean, I thought that was maybe like, yeah, I think you're right. I think because I was thinking of Pepsi, like when they did Pepsi Clear. But maybe
they did do it.
Maybe there was a Ford one too. And that's fine. We can do either one. I mean, we could drink clear Pepsi while driving our Ford F-150s.
I don't think I ever did the clear Pepsi.
I vaguely remember it.
The only like time that a soda company tried to do a weird flavor that I kind of got on was Mountain Dew Code Red.
Oh yeah, I think I remember that.
I never got into the Baja Blast.
I hear that's a big one, isn't it?
Because it's a Taco Bell. I think Taco Bell, you could get it.
Okay, because I feel like I've heard Eli talk about this. My oldest son, I feel like I've heard him talk about Baja Blast.
And I remember Code Red, Mountain Dew Code Red, also being a thing when I was little.
Yeah, it probably comes with the Taco Bell subscription.
Yeah, like Coke Zero and all that stuff. Nah.
Do you know that there's a Taco Bell subscription?
Like, what do you get?
I think you get I learned this from Ethan, who was our intern for our insurance team. Something, I believe you pay I think it's like $10 or something a month, and then you get a taco a day. So you can just go through drive-through and be like, I've got a subscription. Give me my taco. It's something like that.
Every day after school.
Yeah. Like, can you imagine as a college kid? Like, it's perfect for, Ethan's telling me this. I'm like, I can't say that I would do it, but if I was a college kid, are you kidding me? I'd be stopping by Taco Bell and I suppose it's for them, it's a loss leader, right? You get someone there and they're going to get more than the taco. But I'm telling you, if you're disciplined, you can have 30 tacos for $10. It's pretty good.
It is.
I don't know. I feel like that's interesting.
I would have definitely been doing that in high school and college.
Yeah, hands down. I mean, by us, it was Taco John's, but
all right. So volatility.
Yeah.
Spike, man.
Volatility. You did a pretty good job. You took us off Taco Bell and you went right to volatility.
I did. You like that segue?
I do. I love it.
I didn't know how to get us there, but
you did it. No, I think, because you highlighted some things this week as far as where we're seeing the VIX, which is the Chicago Board of Exchanges way to identify where we are with volatility. It's a discounting mechanism. We've covered it on here in the past that, you can, I think it's divide by 16, and that gives you kind of your, it's a rough rule, right? On what your daily volatility to expect is. And I think you had some commentary out there about, in this current environment, you divide by 2 or by 16, and you should expect like 2% moves.
Yeah.
And there were a couple of days where we didn't have 2% moves, which the way I view that is it's like pushing the beach ball underwater. And so it increases the volatility going forward. That's kind of what we got. I mean, like what you're talking about happened.
I think it also just matches the slow grind that we've had this year. We haven't had a March 2020, type of, even if it was like a couple weeks, we were at, or Q4 2018. We haven't seen that. It has been new lows. Then those, get recaptured, and we rally, and then we roll over to new lows, and then there's a failed breakout. And it's just been these 2 to 3% days, and not your 4, 5, 6% days like you've seen in some of these other market.
It's almost like you're describing capitulation. That capitulation is still on the table.
Still, and it goes back to, we've talked about it. Willie, and you mentioned his work on here as well. The positioning continues to tell you that not a lot of people have sold stocks yet.
Yeah, and I think there's a couple interesting data points there. Is we haven't had the high volume sell-off, right? We just had the data's there. We haven't had the high volume sell-off flush. There's data out there showing that on several retail platforms, high levels of cash, however, not taking on short positions. And that's why you're not seeing a VIX spike yet. But I would anticipate that the potential exists of a flush where a ton of people get short at just the wrong time, that then carries us higher out of that hole. But that your point is valid. The flush hasn't happened. We are sitting on that precipice currently. We're not predicting that. We could hold the 200-week moving average and move higher from here. I mean, that's what seasonality kind of suggests. But we haven't seen a flush yet. And that's also the possibility on the flip side, is that you have the next 2 weeks where it's just hard price action to the downside. And too many get caught going short at that point, which allows the market to rebound from that point forward, marking the end of the correction for the time being.
That line up, that does seem to line up with seasonality, right?
Oh yeah, and this would be a good. I appreciate that. That's a great segue, because maybe we could wrap up this episode with just walking through seasonality for this year to paint the picture of what we're seeing, because there's a lot of seasonality information out there, and it tends to focus on bottoms taking place in October. Now, the interesting thing is that a lot of capitulation events, aka crashes, happen in October as well. So couldn't you have both? Couldn't you have the capitulation event, the massive move down, but also marks the bottom in October?
Sure.
And so what I wanted to do, if you're willing, Ian, is go back to start the year and just kind of paint the picture of what we've been seeing seasonality wise for this market, which gives us character of what we're seeing this market provide. And for example, we could start with Santa Claus rally, which is the last 5 trading days of December, the first 2 trading days of January. So what did we see there? What did we see for those last 5 trading days of 2021 and the first 2 trading days of this year? Then we could talk about the first 5 days of January. Then we could talk about January as a whole. And then maybe we just go month by month based on the work done by Stock Traders Almanac, Jeffrey Hirsch, what we typically see in a midterm year as it pertains to a Democratic president. And it's been pretty spot on. And so let's start with those first three, the trifecta, the Santa Claus rally. Did we match up there seasonality wise? Did stocks do what it's historically done seasonally in that period?
Yes, Santa Claus rally works. Not gonna put an asterisk by it. It wasn't the most, if you go back and look, it wasn't the most awe-inspiring Santa Claus rally. It did finish positive basically because it popped on the very first day, then went sideways. Of course, then the day that measurement ends, the very next day, I mean, that was kind of the top. The very next day, stocks sold out.
So basically you're saying then that leads us into the next one, which is the first 5 days of January, which I should highlight 37 out of the last 43 years. So that's about 85% accuracy. When those are positive, the average gain for the S&P is about 15%. But when those are negative, it's about a coin flip, meaning like the year could be negative, it could be positive. It's about 50% either way, could be. And it's really, when the first 5 days are weak, you get about an average return of about 0.2%. And so where were we this year, 2022, first 5 days?
Down.
So, okay, clue number one, first 5 days in January, we're down. So that means we're at a 50-50 scenario, potentially. Again, seasonality is not a guarantee. It's just information that we compare against. And then when we look at something like the January barometer, which is just looking at January as a whole, we know that when we look at historical S&P 500 performance in January, and this goes all the way back to 1950, that every down January, and there's only one exception, but every down January preceded a flat market or a 10% correction or an extended bear market. The only exception is 2016. But every other year that had a down January, the average loss or drawdown in that year was about minus 15%.
Wow.
So,
Okay.
And did we have a positive January or a negative January?
Negative.
So negative. So first five days down, January down. And this makes a lot of, like, it's intuitively obvious when you think about it. Okay, we've got a down January in our hands. That obviously increases the odds of the year overall. Like if you're already heading in a downward direction, it increases the odds of the year overall being down. But when we look at Jeffrey Hirsch's data and we say, okay, let's go month by month. So you just said January's down, which is accurate for a midterm year. That's what we experience. February is down in a midterm year. And I believe we experienced that. Is that correct?
Yes.
March, how were we in March?
March was positive.
Okay, and that's what we saw. That's what we see in midterm years, positive March. Using Jeffrey Hirsch's work, April is positive in a midterm year. How did we do? How the S&P 500
negative this year? April.
Okay, so and that's where if we're technicians and we use this information, we say, okay, seasonality has been locked in until this point, and which direction was it? It was weaker. And so that gives us a clue. Okay, maybe, just maybe, 2022 is going to be weaker than normal. So now May and June, according to seasonality in a midterm election year, is weak. I believe that's what we got.
Yes.
May into late June, mid-June.
May was flattish.
Okay. And then June was
a lot of volatility in May, but ended up a big old doji.
Okay. Indecision in May.
Mm-hmm.
And then for June, we all know that we had a bottom.
Yeah.
In June. And then
June
July.
Bottom, July rally, which lines up.
Yep.
Into mid-August, which lines up.
Yep.
and then you get your Q3 sell off that goes into the end of October.
Right. So we're not at the end of October yet, but you look at the seasonal data, and this is why I wanted to go through this exercise, is because it's an extremely high percentage of market bottoms that happen in October, but it's also an extreme high percentage of market crashes that happen in October. And so why can't it be both? Meaning, if this indecision that we've seen since the end of December, because that's what we get to call it, this 8% range that's closing near a same value, is indecision. If that resolves to the downside and we see some type of capitulation event, which we haven't seen yet, you could potentially have both your capitulation and your market bottom happen this month. Still,
you could.
We have no idea.
Some type of intermediate term, right? Because we saw kind of capitulation in October 2008 too.
No, yes. Talk about this. This is good.
So yeah, you can have capitulation and you can have your Christmas Eve, your Christmas Eve 2018 and your COVID lows, and I kind of even put that February 2018 in there too. But you can also have capitulation lows that, people are done. People sell. And that leads to some choppiness in regards to supply and demand. But then you fall even further. So I would say a lot of people would claim there is capitulation. Probably what they were hoping was capitulation, October 2008, November 2008. And we did, and we got a pretty, November 2008. There's an 8-week span. Markets rallied 26%.
Yeah, for sure.
In November and January.
Yeah, there was a type of capitulation and then a rally, both in October and November.
Another 30%.
Yeah, and then they fell more. They fell more all the way into March of that year. So you could have a capitulation event, a bottom, but that's not the bottom.
Or look at the S&P. The first bottom in the S&P was July 2002. Probably felt like capitulation, looks like capitulation on a chart. And we revisited that. So does capitulation, I think there's also a feeling that capitulation equals that it's a V bottom.
Oh, right.
Okay, now we found out, well, you can capitulate, and that can be, like we saw in 2002, 2003, that's just the left side of you building on a base.
Right. No, it's valid. And this goes back to, well, we're obviously in a correction. Is there a capitulation event? No idea. Seasonality suggests it's possible. And even if that does take place, is that the bottom? Doesn't have to be. Case in point, 2008. Then thinking bigger picture, you've highlighted not all bear markets are the same. In the 2008 correction, everything was correcting. The 2000 correction, 2000 to 2002, you had a correction on your hands, but there were also 3/5 of the S&P that had a positive return during that period.
Yeah.
So, and I think there's evidence to show that there are some characteristics about 2000 to 2003 that are similar to now, in the sense that there are still things doing well and holding up. Now, it's rare. It's far and few between. But, the Eli Lilly's, the LPL, LPL Financial,
yeah.
Your Eli Lilly's, there's
Twinkies.
there's certain things that are holding up. That, do they continue? They absolutely can. And those are worth paying attention to. If you have things that are up in this down tape,
unfortunately, they don't move in the indices.
No. Yeah,
unfortunately,
right.
Hostess brands.
LPL Financial, Hostess brands, Eli Lilly, they don't move the market. 100% agree with that. And I think that's why it's worth paying attention to Apple. Which,
sitting there on one, balance, it continues to hold up, but it is, I say hold up, and it's going to be, on its another red weekly candle.
Yeah, another doji, a doji for Apple.
Look at you go through an Apple weekly chart and you look at some of these upper shadows the last 5 weeks, 6 weeks, maybe 5 weeks, but it continues to finish well off its weekly highs by the time we get to the Friday close.
Yeah. And so
I would say very similar to the market. I think Dietrich had a stat on Fridays this year. And this will be 5 out of the last 7 Fridays are now going to close red.
Which would be the very definition of a downtrend. If you continue to see lower lows, lower highs.
8 of the last 10 will be red, 4 in a row.
Yeah, and
haven't had 5 Fridays, 5 red Fridays in a row since. It's interesting. I would not have expected this. March, April 2017.
Okay.
I would not have guessed 2017 of all years, the least volatile year in recent history. And it actually had 6. It actually had 6 in a row between March and April 2017.
Yeah, and actually that's interesting because I remember that point in time, and it was off to the races after that point. I mean, you had a strong start to the year, but there was some weakness there, but it was muted, and then you took off. But yeah, if you had asked me that question about what year that happened, and it would not have been that one. Completely agree with that. And so here we are, Ian. We have a seasonal environment where in a midterm election year with a Democratic president, and again, that's not a political statement. That has nothing to do with, it's just the data, that you have this potential of another load still taking place in October. And we're here sitting on a 200-week moving average, which we know from David Settle's work and others that below a 200-week moving average, there's a lot of trouble that exists. Paul Tudor Jones talked about nothing good happening underneath a 200-day moving average. Below a 200-week moving average is even more problematic. And so we're sitting there right now in something like the S&P 500, which is the strongest of the strong. Like, I'm not sitting here saying like the S&P 500 is somehow the other things are weaker. International stocks much weaker. Bonds have been weaker. Small caps below their 200-week moving average. There's plenty of things that are weaker than the S&P 500. This goes back to what you just said before, the big boys still kind of holding up. So Apple, Microsoft, Amazon, Google, those types of names, because we still have Microsoft above its 200-week moving average. We still have Apple above its 200-week moving average, well above it. And until those break down, and we've started to see cracks, obviously, when we look at something like Apple versus small caps, that's could have a potential false breakout on its hands, which would lead us to believe that maybe during this period, small caps hold up better than some of these big tech names.
Maybe they do. And you see it in energy, at least from an absolute basis. The others, banks and things and you had industrials in both large and small this year, this week, new relative highs. But do I want to go buy industrials because I think it will make money for clients? That's the part.
No, it's hard to
work on.
Right. And your point is, even if industrials are falling slower, that doesn't mean necessarily it's a great position to be involved in.
Well, I don't want to go brag that I'm just losing less money.
Right. Correct. And so we continue to see weakness. We continue to see bulls have an opportunity and fumble it away. It happened again this week on Thursday, then coming into today, had an opportunity, couldn't hold it. Need to see follow through. For the last 3 weeks, we remain at this really important level in many market indices. And so we need to see this hold for the bullish case. For the bearish case, you could see cracks and you go into the weekend with risk. A weekend risk, if you're hugely long. That's not a recommendation. That's not what we're doing, holding high levels of cash. And that's a position too. And so, Ian, with that, we bumped up to the end of our time together on this episode. Anything you want to wrap up with before we head out of here?
No, just not saying when you look at dollars, interest rates, stocks, fixed income, you look at longer term charts, weekly charts, no change in trend or behavior out there.
Yeah, for sure. Especially with today's information. Today could have been a different story if they'd followed through what they did yesterday, but they haven't. They didn't. And until that changes, until that character changes, we remain in correction territory. And below 3667 on something like S&P 500, the correction continues. So, Ian, appreciate your time. Always appreciate your insights. We're going to jump on our call with the adaptive team, make sure we're taking care of our clients. But to everyone listening, we appreciate you guys listening. As always, and almost every week now, I'm going to ask you guys for high ranking. It really does help us out. You can see it in the data that comes out. So if you love this podcast, if you're enjoying the insights we provide, please give us a high ranking on whatever your favorite platform is. It helps us get the word out.
Have a great weekend, everyone.